Next week, markets try to gauge just how long the Middle East conflict will last.
Plus, with markets focused on energy prices, the US gets a critical inflation update.
And Fed rate cut hopes get pushed back as Kevin Warsh prepares to take the helm. This is Reuters Morning Bid, bringing you unfiltered market news and analysis straight from the Reuters newsroom 7 days a week. I'm Anna Szymanski in London.
And I'm Mike Dolan. It's Sunday, March 8th.
Well, Mike, it was quite a week last week, and it looks like we have quite a week ahead of us. You know, this conflict that's happening in the Mideast is such a rapidly moving story. It's entirely possible that by the time listeners are hearing us, something more will have changed. But one of the main issues that markets are going to be focused on, I think, this upcoming week is just timeline, duration. How long do people think this is going to last?
Yeah, and this is the essence of all the market movement around this. It's seen periodic blow-ups in Middle East politics and conflicts before, and typically the market reactions, at least, whatever about the impacts of those conflicts, has lasted a very short period of time. We're talking days instead of weeks. I think everyone's preparing for this to be weeks, if not months. Certainly if you listen to the Pentagon or you listen to the US administration, they're saying this can
4
take
to 5
anything.
weeks.
Yeah. So for markets to gauge where this is at, it'll be very difficult for anyone to second guess the actual politics or the military campaign itself. However, there are ways to gauge within the market roughly the rules of thumb. And I think we're already seeing an attempt to find the point at which you start to see the peak uncertainty, if you like. And energy will be the lodestar in this. Undoubtedly, the transmission to most of the world economy will be via the energy markets, the crude oil markets and the gas markets that are currently in a hiatus because there is no way of getting supplies out of the region.
In one area where we are essentially seeing bets being placed on how long this is going to last is in poly market.
Yeah, so the two poly market bets that are out there is that the Iranian government, the leadership there, will collapse by mid-year. So that has a betting of about 40% chance, right? So that's quite some distance away. Of course, there are many nuances you could think about. And another market that it looks at whether US troops would enter Iran. And there's unusually over 60% chance that they will have entered at some point by the end of the year. But again, you see the timelines are actually quite long. I think a lot of people would say US troops will not enter in an election year, in a midterm election year. Tell us what you think the energy curves and future curves are telling us about the timelines as far as we can make out.
Well, I mean, right now it looks like if you're looking both at whether you're looking at natural gas or whether you're looking at crude, it seems like people expect that by the end of the year, by early next year, especially by early next year, that things are going to start to normalize. And, you know, speaking of energy prices, we obviously have inflation numbers coming up this week. And now these are going to be backward looking. They're not going to obviously show you what's happening now, but they will be important in terms of saying, where were we going into this? Because now inflation is really the key thing that markets are looking at. I think that these numbers will be, you know, perhaps more important than people would have thought even a week ago.
Yeah, I think the other thing that people look to compare different events of this scale. People, for example, in Europe are looking very much at the Ukraine situation in 2022, the Russian invasion and the impact it had on energy markets then. But one of the things that's interesting about the inflation updates is that we're in a very different place than we were back then. So the backdrop, certainly in terms of policy backdrop, we had very low interest rates, probably a significant amount of fiscal support for economies as we were coming out of the pandemic. It's very different this time around. But the inflation numbers we expect this week, the CPI on Wednesday, and CPI has been relatively well behaved, I think. So that may not be the one that the market will react most to. The one, as always, is the PCE, the personal consumption expenditures gauge that the Fed targets. That's what the Fed looks at. And we get a January update on Friday. Now, the components that fit into that already suggest that the core rate will come in somewhere in the region of 3.2%. And it's rising. It's been rising for the last 2 months. This is a real concern for the Fed because this is before the oil price spike that we've seen over the past week.
And obviously core prices would, in theory, strip out energy. But number one, we know that if energy prices rise, especially if they rise significantly, that can always have the potential to feed through. And also, while the Fed does say that it looks through energy price spikes, if something looks like it could have legs, if it looks like this is not going to be just a short-term thing, then it will be impossible for the Fed to ignore it. And we saw this week that the nomination of Kevin Warsh was moved to the Senate. So I think a lot of focus is going to come back on him taking over in really just an incredibly difficult spot.
Well, the Fed futures have now pushed back. In other words, they're not priced for a Fed rate cut until October, not fully priced at least. And they've taken down full year easing to just 40 basis points or so. So that means they doubt there'll be a second one. And so that's the environment that Kevin Warsh takes over in May, assuming he gets through his congressional hearings. But that's a very difficult moment for him because undoubtedly he has told the president that he's in favor of further interest rate cuts. And if he has to wait until September, October, that's going to be a difficult message to relay back to the White House.
It's Sunday, so let's get you those quiz answers. We asked you about the Bretton Woods system, the post-World War II setup that anchored the dollar to gold. We asked you, what price was gold pegged at under this system? Was it A, $20 an ounce, B, $35 an ounce, or C, $50 an ounce? And the answer is B, $35 an ounce.
For more on any of today's stories, head to Reuters.com or the Reuters app. Follow us on your favorite podcast player. And if you're on a smart speaker, just ask for the latest market news from Reuters 7 days a week.
We'll be back tomorrow.